You're listening to Southpod, Rise of a Region, hosted by Stanfield Gray and John Yarian.
Alex Western, how are you?
I am well.
It's good to be with you. I'm doing fine. I'm waking up. We're going to talk in a minute about the company, about everything you do, but I want to start with an observation, and I hope this isn't too simplistic, but I've been talking to people all day yesterday and the day before who are shopping for talent, they're shopping for technology, they're shopping for ideas, and you're kind of out here shopping for companies. Is that fair? Is that a fair statement?
That's exactly true.
What does that look like? What are these conversations like?
We're talking to, generally speaking, I guess, two kinds of opportunities. We're talking to venture-backed companies that are healthy, potentially sustainable, they've got a good niche, but maybe they're growing like between 0 and 40% per year. So they're not going to outgrow their pref, and the venture investors are wondering, okay, if this isn't the unicorn, like I'm focusing my time elsewhere, but for half of my portfolio, where it's not going to go to the moon, like what's a permanent option for those companies look like? Because they're healthy, it's just not necessarily the growth venture model. So we're talking to those guys, and the second kinds of people we're talking to are, founders who have bootstrapped their companies for 30 years, and they're wondering, how do I make sure this is sustainable? How do I do right by my employees, by my customers, by my investors? What does an arrangement look like where I'm not just selling to the corporate raider private equity types? We're the kindler, gentler alternative, despite how I'm dressed.
You look like a guy who buys companies. That's reassuring. Well, you brought us to an interesting point, because when I think about somebody at a conference like this who wants to buy a company, I kind of think about somebody who wants to like strip it or flip it, who wants to load it up with debt, or attach it, graft it onto some other thing. And that doesn't seem to be the nature of the conversations you're having. You already gave us a hint about that. Maybe talk a second about the model and the difference between what you're doing and the corporate raiders you just referenced.
Yeah, sure. So what ESW Capital actually is a family office-backed holding company of 70 B2B focused software firms and IT services firms. So if you're looking for, in your mind, just picture the Berkshire Hathaway of software. So we're permanently capitalized. We have never sold a company, and we never will. So we're different in that for people who are afraid that they're going to be stripped and flipped, that never happens. For people who don't like the thought of being over leveraged, we do our deals 100% equity. But what you alluded to, the operating model, is really what's different. So ESW Capital started because a tech entrepreneur named Joe Lemont built a really great tech company in the 80s. And once that story played out, he thought, forget my technology, that was cool, but I've also developed a great playbook for how to run tech companies in a sustainable way. So he's like, let's spread the word a little bit. So over 30 years, done 70 acquisitions, and what we've built behind the scenes is an integrated shared services operating model that, to put it simply, it's like economies of scale on steroids. So we will find companies who maybe they're never going to reach 50% EBITDA margins on their own, but in partnership with us, by plugging into a global sales and marketing team that's going to push their products to our several thousand other enterprise customers, or to someone who wants the engineering department that like a $1 billion holding company can provide, but I'm a $10 million revenue startup. We provide those things. So usually we can really grow revenues, usually we can really control costs, and we can do it in a way that doesn't strip anything. It plugs the company in a healthy way into our operating model so we can provide surge capacity as needed.
Well, let's go a little bit deeper here, because this is a sophisticated audience and they all got up early, so I think we can reward them with a little bit more, because I'm getting this whiff that you guys think you got some like secret sauce to run tech companies better. There's like an algorithm to it.
Yeah.
So you can buy them and you're going to run it better, and you believe in that, and there's maybe some kind of a I don't know, there's like a principle in there, a methodology, something I don't expect you to reveal on stage, but I mean, there's something in there that says, this isn't just convenient, we're better at this. Bring it to us and we'll apply our methodology and it's just gonna run. It's gonna run better.
I mean, I don't need to be cagey about the secret sauce at all. It really is the fact that whereas on the front end, or the way customers would perceive the companies, literally nothing changes. Like, there's no Versata or ESW or Trilogy. Those are our predecessor companies before ESW. There's no flag that goes up that rebrands the companies or that changes the way any of their customers would perceive them. But on the back end, everything changes. And that doesn't mean that, you know, you come and you lop everyone off. It's not that. But instead, you almost picture it like, it's like a solar system or something, where each of the 70 companies is on the periphery and they go to market the same way they always have, except everything on the back end is consolidated. So when we do an acquisition, the way it works is we're gonna pair up someone who works for the mothership with everyone who's working at the company, so we can learn how to do what they do well. And hopefully, you know, since we've got a lot of acquisitions under our belt and we're pretty big and pretty good at what we do, we can find a way to improve the processes, but it needs to be a two-way street. It is a two-way street. And during that process, they learn about ESW Capital. The secret sauce ends up being the fact that it is one integrated workforce and set of processes on the back end that those people then plug into. Everyone wears multiple hats.
Is that infinitely scalable? I mean, you got
That's the point.
70-ish, is that right? And is it good to be 71 but maybe not 222? I mean, at what point does this start to fray?
No, I think it's quite the opposite. Our hypothesis is the bigger it gets, the more efficient it gets, the more sustainable it gets, the more career advancement opportunities we provide the people who are working for these portfolio companies who say, wait a minute, now I'm gonna join up, I'm gonna wear the hats I used to wear at my legacy company, I'm gonna be cross-trained with several of the sister companies under the ESW Capital portfolio. You know, in the future, I'm running engineering for 3 companies, I'm running engineering for 5 companies, or I'm the sales manager for not only the product portfolio of legacy company A, but for 4 other of ESW. So no, I think growth only makes the model stronger.
So you're making a momentum argument here, right? There's a snowball, it's rolling downhill. The more that join up, the bigger it gets. There's more power in that, is that
I'm making a scale argument.
Okay. Let's pivot a little bit and get to know you better. I heard a rumor that ESW has been around for 30 years. Is that true?
That's true.
So you started when you were 9 or 10?
Yeah, exactly.
Fair.
Yeah, so
how did you come to the company? What were you doing before? What brought you to this?
Yeah, I was a junior portfolio manager at GMT Capital. It's a hedge fund. I was focused on healthcare on the long side, and I was focused on retail and consumer IT on the short side. My background was originally, you know, in strategy consulting with McKinsey and in private equity with a middle market firm called Audax Group, and I really loved working with companies, feeling like you were building something. And my experience with GMT was awesome because you really develop as an investor when you have to see things at the speed at which the public markets operates, but I really miss building companies. So when the opportunity presented itself to join ESW Capital, and what I do is I founded and I'm building what's called the proprietary deal team, whereas historically ESW Capital has used investment banking relationships or even a network of buy-side brokers in order to find great companies. We're trying to do it internally. We're trying to reach out to companies directly. We're trying to build a bit of a presence. That's why we're here at Dig South. I thought the opportunity was way too cool to pass up. So now it's sort of the best of both worlds. I get to put my investor hat on, but I get to really roll up my sleeves and actually work with these companies. And usually, you know, I mean, like, not to be melodramatic, but it's like, it is sort of like making dreams come true in the sense that it's founders who are like, I want the legacy alive forever. You know, you're not going to change the name, you're not going to change the product, you're not going to, you're going to keep that legacy alive. You're going to do right by my customers. You're going to do right by the employees, and there's more opportunity in the future. That's a cool opportunity for me, and I enjoy having those conversations. It's fun.
What have you learned over the years in searching for, vetting, discovering these companies, discovering their founders? I mean, what are you looking for, beyond the pure, spreadsheet quant stuff? What guides your search?
People, like mutual honesty, really.
Yeah.
Because we're actually not, most investors, perhaps they think more thematically or they have stricter investment criteria. We don't, for several reasons. Number one, we're our own LP, so there's not shackles put on us by our limited partners. But the second reason is our investing is more about sharing our operating model in a way that makes companies more profitable. It's company, vertical, industry, in-market agnostic. So instead, the conversations look more like, let me be super honest about what pro forma ownership with ESW Capital looks like, and be super honest with me about where you are, because for 80% of companies out there, they wouldn't want anything to do with us, because it's like, I want to call my own shots, I want to remain independent, I love the Silicon Valley treadmill, or no, I like the private equity model because they're going to squeeze me, but I'm going to hit the ATM every 5 years as a manager. Like, some people want that. But if you want the decentralized from a management standpoint, but very consolidated from like an economies of scale standpoint, you want to join the ESW Capital family, if you like our operating model, then we're a great fit. And on the investor side, and I'm shifting gears on you a little bit now, but I was having a conversation last week or the week before with sort of a luminary out in the Bay Area, Mike Maples, and he shared an interesting tidbit with me, which was there are only going to be 80 companies per year that exit for 50 million or more. So if you think that venture firms raised like 40 billion last year, and there's only 4 billion of those like big exit opportunities, like what's the disconnect? And that conversation kind of gets to the point of why we do what we do at ESW, which is most investors, the whole market out there is just growth, 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 growth. And when you're growth, 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 growth oriented, like I understand you're playing a portfolio game and something's going to go to the moon, but a lot of things aren't. But what happens to those companies? So if you're focused on growth first, and then maybe I'll make it profitable in 20 years, but maybe not, and then like in distant third place is doing right by your customers, we at ESW try to flip that entirely. So first, it's delight core customers. We don't try to add new logos to any of our portfolio companies for over a year. We literally just focus on consolidating the base. If we can drive gross economic retention for our portfolio companies in excess of 95%, then we know we're doing right by our core customers. Then and only then do you try to design the profitability engine behind that. Then and only then do you use that as the lens through which you view other growth opportunities. If you invert the traditional model, growth, maybe some profit, maybe I'll do right by my customers. No, delight your customers, make it profitable, and then and only then strive for growth. That's a model that works for us, and because we're permanently capitalized, we can be patient enough to make that work. Banks, venture firms, growth equity investors, private equity investors, they come to us when they say, I get it, my playbook works for me, but as a venture investor, for the 50% of my companies that aren't going to return 1x capital or more, but deserve sustainability and could be flourishing under the right ownership, you can provide superior equity returns on my embedded equity, and it's a win-win.
Well, it's interesting. I mean, it all makes sense, and we've stunned them into silence. I mean, they're listening. What I'm wondering is 30-year track record. It's news to me. I didn't know ESW until a couple days ago, and yet
we keep that secret pretty well.
Well, you're here though, and you're doing this. And what I wonder is this part of an initiative, a shift in strategy? Is there a visibility push? Is this something that you're doing in particular around your group? Talk to us about, this visibility versus what we didn't know,
right.
A month ago.
It is. So our founders are actually pretty publicity shy. I mean, shy is the wrong word, but they don't court it. And I mean, it's a tech operator. Like, he's a stud and he's awesome at what he does, but he doesn't want to be drumming up deal flow or, trying to cultivate relationships with intermediaries and venture firms, growth equity. It hasn't needed to be the core of what ESW's done because we started with one company, then bought another, and another, and another, and it snowballed. But now we're at the point where on an LTM basis, we've done 17 acquisitions. Like, it's getting so big that in order to meet our capital allocation goals, we've got to be more proactive. So that was the impetus behind ESW wanting to build the proprietary deal team, and that's what my colleagues, Phil Trench, Nicholas Daniele, and Natalie Beard and I, we're all here today, by the way, so be sure to shake hands with those guys. That's what we're doing, and it's exactly what you said. We haven't focused on getting our name out there because we weren't that big. Now it's snowballed to the point that, no, we really think we're onto something. We really think it's a great solution for companies. We think it's a great solution for debt providers. We think it's a great solution for growth equity, venture capital investors. So we want to get our name out there more. We want people to know about us early enough that there are plenty of like seed stage or A-round companies I'm talking to over the last 2 days where I really hope that if they're looking for a permanent capital provider in 2 years, they'll think of us because we had a great conversation at Dig South. We just need to get out there more. So that's what we're trying to do.
What do you face when you evangelize, when you tell this story, when you meet with people? I mean, it all makes sense to me, but what do you run into when you're speaking to a founder, owner, operator, entrepreneur who just didn't know there was a way to do it this way? They've read and heard and listened to all the podcasts, and they think they just got to get churned up by this other thing. What does that look like for you in explaining it?
That conversation goes one or two ways. One is someone who's like, I don't even see what the point of it is. Like, I want, I want the growth. I don't even get, like, you sound like you're decelerating me, or you're focused on for some people, there's just not a match in terms of like, hey, here are our values and here's the way we think about the world, and like, what do you want? So, all right, our solution's not for everyone. The second camp is more interesting. Like, sophisticated people look at what we're doing and they're like, I get it, it works, but you're a bottom feeder. Like, come on, man. Like, so I get it. Doesn't everyone want companies that, it seems like it's a broken investment banking auction process? Well, doesn't everyone want one of those? Or, proprietary deals. Well, everyone wants those. Or someone saying like, a debt provider is like, wait, this company's a little overextended. Well, everyone wants deals like those, right? So come on, man. Like, this is just you trying to be a distressed investor, or you're being a bottom feeder. Like, I see past all that. We just try to like be honest about who we are, how our operating model works, what kinds of acquisitions we do. Because when you go open kimono and you sort of share that, all right, this is the opportunity we see with this company. It's $5 million in ARR and it's still burning $1 million a year. We think that for 1 year, we're going to up the burn actually while we partner our existing people with their people. We think by year 3, as 30% of your workforce joins the consolidated mothership and is adding value to other portfolio companies. And then as 20% of your employees say, I don't like this virtual distributed shared services operating model, so I'm out. And as 20% of the employees aren't up to the ESW sort of global holding company standards, so they have to transition. Like, on a pro forma basis, this is what we think it's going to look like. Is this a good deal for you? Because this is how we think about the world, and this would be a good deal for us. Just have open and honest conversations. You find great common ground.
I want to briefly recognize you for using the phrase open kimono. I think it escaped some people. It's early, but I thought it was fun. I love that. So feel free to use it later. Eric heard it. Great. Landed for some people. So we've got this model. We've got the system in place. We're actively growing it. You're here. briefly paint us a picture of the kind of company you're looking for. It has to be B2B software within certain characteristics. I mean, make an outline of that so we really know what it is.
A minimum of $2 million in revenue. We are geographically agnostic. We are in-market and vertical agnostic. But it does need to be at the $2 million minimum threshold. We like high recurring revenue because, again, our model is all about delighting core customers and trying to build on that foundation. It needs to be B2B because we feel like we've sort of cracked the code on enterprise sales and increasingly on SMB sales, so we don't do consumer companies. And I guess broadly speaking, the three kinds, of models or companies, SaaS is great, but everyone loves SaaS. So those companies are generally in more competitive processes. Even on-prem software, we love on-prem way more than most investors do, or B2B IT services, emphasis on like the IT. But those are that's the profile we're looking for. $2 million in ARR, SaaS, on-prem or IT services, and high recurring revenue with high retention rates, because that's the foundation that we build on.
So you got a reaction out of this tape. Might have been on-prem. Is that what?
Well, I reacted that way. I just have a question. Can I?
Yeah.
So should I be assuming that all your investments or acquisitions are 100% owned acquisitions? And if so, how do you keep the entrepreneur involved? Okay, is his head in the game, or is the entrepreneur, the founder, whomever, really just? It sounds to me like they're just looking for an out. They're tired of managing the entire company and they want an exit. And to some degree, that doesn't really resonate with me a whole lot.
So we got a question about founder involvement.
Right.
In probably 70% of cases, the founders transition. And if I heard you correctly, you said that may not necessarily resonate with you. One of the things we've done since the first of this year is launch what we call the Think 3 initiative. And the whole idea is that over 100 deals and 70 acquisitions, we've had a lot of conversations with founders who led us to the conclusion that founders should be thinking of their careers and time as their portfolio, almost like venture investors think of their portfolio and the numerous companies they have to invest in as their portfolio. So most founders, if they're not literally living their dreams or they don't think their company's going to the moon, they should take another shot on goal. But they should do it in such a way that doesn't wind their company down. They should do it in such a way that does right by their investors, by their customers, by their employees, et cetera. So the Think 3 initiative has already got 4 deals under LOI from founders who are like, I get it, this isn't my unicorn. It's like dog years, I'm gonna take what I've learned, I'm even gonna take half the team, I'm gonna start the next thing, but I wanna do right by what I've already built. So you're gonna take it over, right? You're gonna honor the legacy? Absolutely. Founders who wanna retire, that's a story that everyone would be familiar with. Plenty of people want to transition if they're founders, if they don't buy into the operating model. So if they think to themselves, I'm used to calling my own shots, so the thought of joining a holding company of 70 acquisitions where I'm gonna report up to one of 8 portfolio CEOs who then reports up to the top 2 guys at ESW Capital, I understand why that's a good outcome for my company, but that's not what I want for my day-to-day, so I wanna do something else, but this is still a good financial outcome. They make that decision. But the last core group are those who actually want to be a part of the ESW Capital family. Some people are like, I've always wanted to be a private equity-backed CEO. I'm gonna learn a ton. We have several individuals that are now making more in terms of cash comp on an annual basis than they made from the initial sale of their company, because now they're running multiple companies under the ESW banner. But are they 100% acquisitions? Yes, they are. How do we keep founders engaged? We just have open conversations with them about what they want. Some people want increased responsibility. Some people want a path to higher cash comp. Those conversations are always bespoke. But if we don't make founders happy, we don't have a good business model. So we do focus on that.
And it seems like there's a particular psychology there in the founder that you would be looking for, or that would create a fit, right? There's an attitude or a recognition, a perspective of how they see their time and how they see opportunity. Is that a pretty fast, like early on clarification for you? I mean, you get with somebody, you'd probably tell pretty quickly if they're geared in a way that would even have you explore the rest of it. Is that fair, or is it the other way around?
No, you're exactly right. That's like the first conversation. We try to do things very differently at ESW, and I'd love a chance to expound on that. But in this specific instance, in my first conversation with a founder who's interested in talking to ESW, it's, hey, just so you know, here's our shared services operating model. Here's how your people would fit in. Here's how we would envision pro forma ownership. This is the playbook. What do you think? We pay 1 to 2 times revenue. What do you think? Our terms are incredibly seller friendly. It's all cash at close. It's going to be 45 days from the LOI. This is generally what the terms look like. What do you think? What questions do you have for me? We try to have what most people think of as the awkward conversations super early on. Because if we do, we clear the air, we know we're on the same page, then you can focus on what's really important, which is building a winning enterprise. But we feel like most people actually do it in reverse. If you'll forgive the expression, you try to get people deal pregnant. You try to do the seduction, and then finally it's like, well, by the way, back when I used to work at another private equity firm, it was, well, no, I mean, this is how it's really going to work. You're actually an add-on acquisition for this other platform, and it's probably going to be 70% pro forma debt capitalization, and you're fired, and actually we think we're going to retrade this part of the LOI. It's like, what? We try to never do that. If we never do that, we have a more positive reputation in the marketplace. If we have a more positive reputation in the marketplace, we get more at-bats. What particularly about this whole process really has you most excited? Obviously, there's capability and passion all over the place, and you've spoken to the full spectrum, but for you as an individual, is it about that moment when a founder realizes there's a way to do this they never knew before, and it's just moving them to the promised land? Is it the thrill of the hunt? Is it being in a room with a lot of potential and you're going to suss it out? Is it sitting down with somebody 5 years later and going, oh yeah, it worked, I told you? For me personally, it's about building something. Because for my entire career, I felt like I was a part of great organizations, but honestly, there wasn't anything truly distinctive about what they were doing. McKinsey is a fabulous firm with a fabulous culture, and they are very thoughtful about how they serve clients. And the same could be said of a lot of consulting firms. Audax Group is a fabulous middle market leverage buyout investor, and the same could be said of a lot, so on and so forth about GMT Capital, which is a value-oriented hedge fund. The idea of the shared services operating model and providing sustainability to like the 50% of a venture capitalist's portfolio that otherwise doesn't have a great option, it works. I mean, it works at a gut level, an intellectual level. It certainly works at a financial level. And we're in the beginning stages of it. So building a private equity, a more holistic private equity model around that is just really exciting personally. But speaking more broadly, like, who's seen the HBO show Silicon Valley? Like, I mean, yeah, everyone, like, it's getting to the point where everyone knows it's a bubble. And I mean, we at ESW Capital kind of scratch our heads at the VCs that are like spinning in circles on their hoverboards while they're like saying disrupt to themselves in their AirPods over and over again. Like, it's just, we're the alternative to that. Why
doing that later today.
Exactly. Why does it need to be steroid injected growth for growth's sake, and then wrecking 9 out of 10 companies so one will go to the moon and that model works? Okay, honestly, great. I get it, you're taking moonshots, but we want to build sustainable businesses out of all the rest of those companies that deserve that.
Well, I think part of it, and I've got a couple more, and then if there's anything from the audience, raise your hand. I think part of it, what you describe is people getting caught up in the noise and the flash and the empty calories, and it almost seems like you're coming to the table with something a little bit more nutritious, right? It tastes good, but saying, look, this don't get caught up in getting written up or having your picture taken. Find a home for your concept and your people, stay connected to it, move on, do something else. Is that fair?
Yeah, absolutely, but it's sobering. The first time, almost all of our acquisitions are partnerships that we develop over a year or more. Because the first time you're having a conversation with someone, we're going to close a deal in 2 weeks with a founder who, the first time we had a conversation, he's like, "You got to be kidding me! I wouldn't sell for less than 5 times revenue." And we stayed in touch. He respected our earnestness, and he sort of got to the altar with 2 other potential capital providers, and then realized that, wait a minute, our offer is between 1 and 2 times revenue, but it's certain,
it's real.
It's certain, it's timely, and the terms are incredibly seller friendly. And once I ran the math on all the asterisks on the others, and then once they retraded me, and then once they said there was going to be just 60 more days to run through this approval process, I sort of realized what else was going on. And it's not seeing the light. It's not that we're right or anything like that. Rather, it's nutritious. We're offering up a different.
Stick.
I know, right? We're offering up a different path to sustainability,
yeah.
And honestly, not all buyers and investors, I would argue, treat companies the right way. So if you're principled and you are certain to close, you're all cash, you're very forthright, and your terms are seller friendly, you can differentiate yourself by just doing business the right way.
Yeah. We'll get you out of here on this one. I wanted to shift to geography just for a minute. I want to preface this question by saying we're not actually here to just cheerlead the Southeast. We live in it and work in it. We want to have an intelligent conversation about it. So with that said, with that disclaimer, knowing that it doesn't sound like you really think in terms of geography. You're looking for great companies, but what's it like shopping or looking in the Southeast? What is that experience for you in an Atlanta or a Charleston or a Raleigh-Durham?
I love it for a whole host of reasons. So at a personal level, I was born in Columbus, Georgia. I was raised around Atlanta. All 8 years I was in Boston. I love the city, but I felt like a fish out of water. The Southeast is home, despite the fact that I've lost my accent. I love it, and it's great to be here. But there's even a business point to be made, which is, again, there's such a bubble in the Valley, in New York, in Boston, that's not where we feel the great opportunities are. We feel like if we're talking about the United States, the great opportunities are in the Midwest, they're in the Mid-Atlantic, they're in the Southeast. We do increasingly probably like 30%. 30 to 40% of what we're looking at right now is actually outside the United States. Again, less competitive, more opportunity. It's like sort of where the developed markets are a little bit earlier. But as we think about the landscape of opportunities for us, people are too narrowly focused on just what they consider those hubs of innovation. Mm-hmm. That's not true. The startup scene in Charleston is amazing. The tech scene in Atlanta is nascent, but amazing. People are already talking about Austin in the same breath. They talk about the Valley sometimes, Nashville, Chattanooga, Birmingham. There's opportunity everywhere. We want to get ourselves out there because not enough smart people are looking there yet.
We want to learn more. If we want to educate ourselves more about your process or the company, where should we go? How do we? Shoot us an email, call us. There's not really a catch other than we'll be honest with you in terms of what we pay, and it's 1 to 2 times revenue. That's the catch. Other than that, we try to be a delight to work with. The way we think about the world is we try to be very certain because we're permanently capitalized. There's no contingencies on our offers, anything like that. We try to be very quick. Generally, an entire process, soup to nuts for us, is 60 days. We'll meet a company. A week later, we can go to IOI with valuation. They'll usually sit on it for a week, mull it over. If they like our IOI, it's a week-long process for us to get an in-depth diligence conversation with one of our operating partners and to get a pre-LOI data request turned around. Both of those are briefed, by the way. Then we can go under LOI, which we've closed 98% of those historically. We've walked away from 1. And we do that in 45 days. Whole process is 60 days soup to nuts. And the last point, which I've alluded to earlier, is we try to make the terms incredibly seller friendly because we're so big now that the way we're successful is
by doing more deals, and you only do more deals if you don't nickel and dime people, and you only build a sustainable enterprise if you have a positive reputation in the marketplace. So that's the way we're going about it. If it's interesting for any of your portfolio companies, or if you just want to learn more about the model because the whole idea of the holding company sounds intriguing but bizarre, call us, email us. We'd love to hear from you.
Alex Western, ESW Capital, thank you.
Thank you for listening to Southpod, Rise of a Region, where innovators dish on success, failure, and a rapidly evolving South.